Hello, David Moore, Equity Advantage, 1031exchange.com. We're going to talk a little bit about state issues, just a small little segment, something to be aware of and something to think about. So we have lots of transactions going on these days where we've got changes of ownership, reset periods. We might have situations where we're doing an improvement exchange. Now, if you look at 1031 in traditional context, people, it's a swap, right? You've got something, I've got something, and we swap those properties. For that to work, we've got to have assets that are obviously of like kind and similar values and equities, which how often are you going to find that situation? So an exchange in today's context is really a three-way exchange. We're an exchange facilitator. You pay us a fee to take your sale and purchase and turn it into an exchange. Now, in traditional thought, once again, even with a third party, you're thinking in a delayed exchange format, meaning that you're going to put a property in the market, list it for sale. When you get that sale pending, you're going to reach out to us as soon as escrow is open, give us information regarding that sale, who's handling the escrow number and a phone number, your name, address, phone number, and email address. Obviously, we want to talk to you about what's going on. But one of the things we want to know is where's the property that's being relinquished? Where's the replacement property? And the reason we're going to talk a little bit about states these days is if we have changes in ownership, for example, then you've got, we just did a segment on drop and swap and drops a little bit where we're resetting holding periods, let's say. Now, is there risk in those things? And I said yes, and there's more risk in states that have a state tax than states that do not. So, if you ever were looking at a map of the United States and looking at the red and blue states, the reality of today's world is we've got lots of rent control refugees going from blue states to red states for just the rights of ownership. But a lot of those red states are so popular. Another reason people are going there, in addition to having some ownership rights, is they might not have a state tax or a reduced state tax. And why that's important is it used to be possible you could exchange out of, let's say, California into Nevada, Texas, Washington State, someplace like that, and you would be able to defer all your gains out of California into those states. Now, in the late 90s, Oregon had a lawsuit that changed things on the state level because there was a discrimination between residents and non-residents with tax treatment of exchanges out of the state of Oregon. Well, the state constitution of Oregon prohibits discrimination between residents and non-residents. So what would happen is pre this lawsuit, you'd exchange out of Oregon into, let's say, Nevada, hold the property for a year or so, sell it, and then you would get rid of the Oregon tax at, let's say, 9% at that point in time. It made sense for a period of time till Oregon figured that out. So the way the law is today, Oregon has a clawback. California saw Oregon put this law forward, and California put the same thing in there. Now, why I say that's important is if you want to save yourself some money on taxes, it used to be a great idea. You exchange out of the state, as I said, hold it for a year or so, then sell and take the exclusion. Today, you can continue to maintain tax deferral if you're doing exchanges. But if you just think, hey, I'm going to exchange out of, let's say, California or Oregon and into one of these zero tax states and save myself 10%, it doesn't work. They've got clawbacks in place. So basically, both states are going to honor 1031 as long as you do 1031 exchanges. But if you do the exchange into one of these zero tax states and at a later date decide, well, gee, I'm going to sell now, this is a great idea, I save myself that 10% roughly, that doesn't work any longer. So both those states do have the right to claw back the gains that were deferred out of them. It's not going to cost you more, but you're just going to have that tax exposure. Now, another one of these quote-unquote great ideas that used to work is if we're converting assets. Now, think about Section 121's 250 or 500 and what happens there. Now, we've got, if you check out our YouTube channel, type in Equity Advantage, what are you selling, what do you want it to be? It's going to talk about converting assets back and forth. But I'm just going to talk about it real quickly again because people think they got these great ideas. They used to be great ideas, they don't work anymore. So what I'm talking about right now is there's lots of reasons to convert a primary residence into an investment. And that biggest reason is that you've got gains in excess of 250 or 500 that Section 121 allows you to have. Now, Those numbers meant something in the late 90s. They don't anymore. So we've got lots of situations where people are going to convert their primary residence into an investment property. Let's say hold it for a year. They still are entitled to the exclusion, and then they 1031 the overage. If you don't want to do that, you don't have the time. The other option to get away from some and to mitigate some of the tax consequence on a home sale with gains in excess of 250 or 500 is to do a QOZ or OZ, qualified opportunity zone or opportunity zone, for the overage beyond the 250 or 500, and you get some preferential tax treatment there. And the great thing about an OZ is I look at them sort of like Roth IRAs. You got limited deferral into that thing, but if you hold it through its maturity, that 10-year hold, whatever you make on that OZ project is going to be tax-free. So that's something that's there if you're in a high tax state converting assets or looking at a situation where your home's going to have that huge gain. Well, on the acquisition side, we have people that want to go buy something and convert that investment to a residence. Now, I can give you a court case where 4 months was deemed long enough. I'm not going to tell you that is. I'm probably going to tell you a year based on two factors that's been proposed a couple times, and that's where the break between short and long-term tax rates on assets held for investment is. Now, I said held for investment because 1031 applies to assets that were acquired with the intent to hold for investment and have been held for investment. So understand that flipping property does not fit 1031. You're going to pay normal income tax on those dispositions, and you're not going to have the ability to do an exchange. Now, that's not to say if you bought something with the intent to hold and you haven't done this stuff in the past and you got an unsolicited offer that's too good to pass up, you can take advantage of that. But that's a conversation you're going to have with your tax people. If you want more information on holding periods, give us a call. We'll get some information out for you. But in that scenario where you're buying a property with the intent to convert it from let's say, an investment to primary residence, and then you think, well, hey, I've got that great idea. I'm going to sell it and pay no tax per Section 121. That doesn't work. It hasn't worked for a long time. First, the government put a 5-year hold on that acquisition property. So if you bought a property, converted from investment to residence, if you sold it inside 5 years, it's a fully taxable sale. And then in 2008, they put the Housing Assistance Tax Act in place, which really allows prorations of the 250 or 500, and those prorations are attributable, the gain that's attributable to qualified use versus non-qualified use period. So if you've got questions on this, please don't hesitate to reach out and give us a call. And we've got great information on it. We can get it to you. Go sit and talk with your tax people. But, all these things, the government figures this stuff out over time, and they sort of plug those holes. So, at this point in time, once again, we're talking August of 2023. Every state in the union actually does honor 1031. Pennsylvania was the last one, sort of a holdout, but everybody honors 1031. One of the reasons it's probably zero tax states, another reason those states are popular in the acquisition is if you're having some tax issue, potentially, you don't have the state Department of Revenue chasing you in addition to the IRS. So that's something that people are talking about, thinking about with respect to some of these changes and doing some of these things. So hopefully I've answered some of your questions. David Moore, Equity Vantage, 1031exchange.com. Look forward to talking with you soon. Thank you.